So you make too much money for a normal Roth IRA contribution in 2026, and now you're wondering, great, does that mean I'm locked out of one of the best retirement accounts in America? Not necessarily, because there's a completely legal strategy that can still get $7,500 into a Roth IRA in 2026, or $8,600 if you're 50 or older, even if your income is above the regular Roth IRA limits. And the crazy part is, a lot of high earners either do it wrong, delay it for years, or accidentally trigger taxes they could have avoided. In this video, I'm going to walk you through exactly how this works, who can use it, the step-by-step process, the biggest tax trap to avoid, and how to do this cleanly and legally in 2026. Because this is one of those moves that can quietly add a lot of tax-free wealth over time if you understand the rules. The big picture. Why high earners get blocked from a direct Roth IRA? Let's start with a rule that frustrates a lot of people. In 2026, the IRA contribution limit is $7,500, or $8,600 if you're age 50 or older. But your ability to contribute directly to a Roth IRA depends on your modified adjusted gross income, also called MAGI. For 2026, if you're single or head of household, your Roth IRA contribution starts phasing out at $153,000 and disappears at $168,000. If you're married filing jointly, the phase-out starts at $242,000 and ends at $252,000. And if you're married filing separately and lived with your spouse during the year, the phase-out's basically brutal. It starts above $0 and is gone at $10,000. So if your income is too high, you can't just log into your brokerage and make a regular direct Roth IRA contribution for the full amount. But, and this is the key, the IRS still allows conversions from a traditional IRA to a Roth IRA regardless of income. That's the opening. That's the legal loophole people are talking about when they say Backdoor Roth IRA. And just to be clear, this is not some shady offshore trick. It's simply using existing IRA contribution and conversion rules in sequence. What the Backdoor Roth IRA actually is, the phrase sounds complicated, but the move is simple in concept. Step 1, you put money into a traditional IRA. Step 2, you convert that money into a Roth IRA. That's it. Why does this work? Because while income limits can block direct Roth IRA contributions, the IRS says you may still be able to convert traditional IRA amounts into a Roth IRA regardless of your adjusted gross income. So the Backdoor Roth is basically a two-step workaround. Contribute to traditional first, then convert to Roth. Now there's an important detail here. For many high earners, that traditional IRA contribution is usually non-deductible, meaning you typically do not get a tax deduction for it. You're putting in after-tax money, then moving it into the Roth. If done cleanly, that often means little or no tax on the conversion itself, but cleanly is doing a lot of work in that sentence because there's one major trap that can mess this up. We'll get to that in a second. Who this strategy is best for. This strategy is especially useful for people who make too much for a direct Roth IRA, still want more tax-free retirement money, already max out or partially max out workplace accounts like a 401k, and want more flexibility later in retirement. Why? Because Roth IRA money can grow tax-free, qualified withdrawals can be tax-free, and Roth IRAs don't have required minimum distributions during the original owner's lifetime. That combination is powerful. It gives you future tax diversification and more control over retirement income planning. And by the way, if you're enjoying this in-depth breakdown, I'm Alex Rivera, and this is Finurix Growth, the place where we make personal finance and investing simple, practical, and actually useful for building real wealth. If you want more videos like this every single week, hit that subscribe button and turn on the notification bell. It really helps me keep creating this level of content for you. step by step, how to legally put $7,500 into a Roth IRA in 2026, here's the clean version of the process. First, open a traditional IRA if you don't already have one. Most major brokerages make this easy. Second, contribute up to the 2026 IRA limit, which is $7,500 if you're under 50, or $8,600 if you're 50 or older. Remember that IRA limit is shared across your traditional and Roth IRAs combined. It's not $7,500 into each. It's one total annual IRA bucket. Third, because you're likely over the income threshold for deducting that traditional IRA contribution, if you're a high earner, you usually treat that contribution as non-deductible and track it properly on Form 8606. The IRS uses Form 8606 to report non-deductible IRA contributions and Roth conversions. Fourth, once the contribution settles, convert that traditional IRA money into a Roth IRA. Fifth, file your taxes correctly and make sure Form 8606 is included. This is one of the most important paperwork pieces in the whole strategy. If you don't document your after-tax basis correctly, you can make your taxes harder than they need to be and potentially pay tax twice on the same dollars down the road. That's the legal pathway. And yes, for most people, it really is that straightforward. The biggest mistake: the pro rata rule. Now let's talk about the part that trips people up, the pro rata rule. This is the rule that makes people say, wait, I thought my backdoor Roth was supposed to be tax-free. Why am I getting taxed? Here's the issue. The IRS does not always let you isolate just the brand new after-tax contribution and pretend your other IRA money doesn't exist. When you report a conversion, Form 8606 looks at the total value of all your traditional IRAs as of December 31st, plus rollovers. And for these instructions, traditional IRAs generally include traditional SEP IRAs and traditional simple IRAs too. In other words, the IRS looks at your pre-tax and after-tax IRA money together when calculating the taxable portion. So let's say you contribute $7,500 after tax to a traditional IRA in 2026, planning to convert it. Sounds clean, right? But imagine you also already have $92,500 sitting in another traditional IRA from old deductible contributions or rollover money. Now your total IRA balance is $100,000 and only $7,500 of it is after-tax basis. That means only 7.5% of your conversion is treated as tax-free basis, and the rest is treated as taxable according to the pro rata formula. That is the trap. So if you've got pre-tax money in traditional IRAs, SEP IRAs, or simple IRAs, do not assume your backdoor Roth will be tax-free. This is why some high earners love the backdoor Roth and others get burned by it. How to avoid the pro rata problem? The cleanest version of a backdoor Roth usually happens when you have little or no pre-tax money sitting in traditional SEP or simple IRAs at year end. One common way people reduce the pro rata issue is by rolling eligible pre-tax IRA money into a current employer's 401k if that plan accepts roll-ins. Why does that matter? Because 401k balances are not counted in the IRA aggregation calculation for Form 8606. The IRS aggregation is focused on your IRA balances, not your 401k. That can be a huge move, because somebody with a big rollover IRA may think, I can't really use the backdoor Roth efficiently. But if their employer plan allows inbound rollovers and the fees and investment options are decent, moving that pre-tax IRA money into the 401k can clear the deck for cleaner backdoor Roth contributions later. Now, this is where you want to be careful. Not every employer plan accepts rollovers. Not every plan has good investment options. And if you have a simple IRA, timing rules can be more restrictive. So this is one of those moments where a CPA, or fiduciary financial planner, can earn their keep. Do you need to wait between the contribution and the conversion? A lot of people ask this because they're worried it looks too obvious. There's no IRS rule in the sources I reviewed that says you must wait a specific number of days between making the traditional IRA contribution and converting it to a Roth IRA. The contribution and conversion are separate legal steps. The main practical issue is usually just waiting for the brokerage to let the contribution settle so the conversion can be processed. Now, some people leave the money in the traditional IRA for a while. Others convert quickly. Why do many people prefer converting sooner rather than later? Because if the money gains value before the conversion, that gain can become taxable on conversion. If you contribute $7,500 and it grows to $7,650 before you convert, that extra $150 may be taxable depending on your basis situation. Not the end of the world. But it does create a little extra tax reporting and potentially a tiny tax bill. So from a simplicity standpoint, a lot of people like to contribute and convert relatively quickly. When is the deadline? You can make IRA contributions for a year during that year, or by the due date of your tax return for that year, not including extensions. The IRS says most people can make 2025 IRA contributions by April 15th, 2026, and the same general rule applies for annual IRA contribution timing. So for a 2026 contribution, the normal deadline is your 2026 tax filing deadline in 2027, excluding extensions. That means you do not necessarily have to finish your 2026 IRA contribution by December 31st, 2026. But here's my practical take. The earlier in the year you do it, the cleaner it usually is. Less chance of forgetting, less chance of paperwork confusion, and more time for the money to get into the Roth environment. What if you accidentally contribute directly to a Roth IRA anyway? This happens more than you'd think. Someone's income ends up higher than expected. They made a direct Roth contribution early in the year. Then tax season comes around and surprise, they're over the limit. If that happens, don't ignore it. The IRS says excess IRA contributions can trigger a 6% excise tax for every year the excess stays in the account. To avoid that, excess contributions generally need to be corrected, often by withdrawing the excess plus earnings by the relevant deadline. This is one reason many high earners skip the direct Roth contribution entirely and just use the backdoor method from the start if they know there's a real chance their income will be above the limit. It reduces the guesswork. Important tax reporting. Form 8, 606 matters more than people think. I want to slow down here because this is where a lot of people make preventable mistakes. The backdoor Roth is not just about moving money. It's about documenting what happened. If you make a non-deductible traditional IRA contribution, Form 8606 is how you report that after-tax basis. If you convert traditional IRA money to a Roth IRA, Form 8. 606 also helps determine what part of that conversion is taxable and what part is not. So even if the dollar amounts are small, the form matters. And this is also why I tell people, don't just rely on the brokerage tax form showing up and assume everything is automatically interpreted correctly. Custodians report transactions, but you or your tax preparer still have to report the basis correctly. This is where I thought TurboTax would figure it out becomes an expensive sentence. A simple, real-world example. Let's say Mia is 37, lives in Texas, earns $190,000 in 2026, maxes out her 401k, and wants more tax-free retirement money. She can't make a full direct Roth IRA contribution because her income is above the 2026 single filer Roth range, which phases out from $153,000 to $168,000. So Mia opens a traditional IRA, contributes $7,500 as a non-deductible contribution, then converts that amount to her Roth IRA. If she has no other pre-tax IRA money sitting around at year-end, this can be a very clean, backdoor Roth setup with little or no tax beyond any small gain that occurred before conversion. She files Form 8606 with her tax return, and now that money is sitting in the Roth IRA, where future qualified withdrawals can be tax-free. Now let's change one fact. Mia also has an old $100,000 rollover IRA from a previous employer's plan. Now the conversion math gets messy because of the pro rata rule. Suddenly the conversion is no longer mostly isolated after-tax money. A chunk becomes taxable based on the ratio of pre-tax to after-tax funds across her IRA balances. Same person, same income, same intent. Totally different tax outcome. That one detail changes everything. Backdoor Roth versus mega backdoor Roth. Quick pattern interrupt, because people mix these up all the time. Regular backdoor Roth IRA uses a traditional IRA contribution followed by a Roth IRA conversion. A mega backdoor Roth is something completely different. That usually involves after-tax contributions inside a 401k plan and then rolling or converting those funds to Roth depending on what the employer plan allows. They are not the same strategy, so if somebody tells you they put way more than the annual IRA limit into a Roth using a backdoor, they may actually be talking about the mega backdoor Roth through a 401k, not the standard backdoor Roth IRA we're discussing here. Common mistakes to avoid mistake. Number one, contributing directly to a Roth IRA when your final income ends up above the limit. Mistake number two, forgetting that the IRA limit is combined across traditional and Roth IRAs. Mistake number three, ignoring old traditional SEP or simple IRA balances and getting blindsided by the pro rata rule. Mistake number four, waiting until tax season, scrambling, and filing Form 8606 incorrectly, or not filing it at all. Mistake number five, assuming the one rollover per year rule blocks this strategy. The IRS says that one per year limit does not apply to rollovers from traditional IRAs to Roth IRAs, meaning conversions are excluded from that specific limit. That last one is a big misconception. Should you do this every year? For many high earners, yes, this can be an annual habit. Think about it. If every year you legally move the maximum IRA contribution into a Roth environment, you're building a bucket of money that may be extremely valuable later when tax rates, retirement income planning, Medicare planning, and withdrawal flexibility all start to matter more. A single year is nice. 10, 15, 20 years of consistent backdoor Roth contributions. That can become seriously meaningful, especially if you're investing the money instead of letting it sit in cash, because the real magic here isn't the move itself. It's what happens after the move. Years of potential tax-free compounding inside the Roth IRA. Final takeaway. So, can you legally put $7,500 into a Roth IRA in 2026, even if you earn too much? Yes. For many people, the answer is the backdoor Roth IRA. The clean version is simple. Make a non-deductible traditional IRA contribution, convert it to a Roth IRA, and report it correctly. But the big warning label is this. Check for existing pre-tax IRA, SEP IRA, and simple IRA balances before you do anything, because the pro rata rule is what separates a smooth move from an unexpected tax bill. And remember the 2026 numbers. The IRA contribution limit is $7,500, or $8,600 if you're 50 or older. Direct Roth IRA contributions phase out at $153,000 to $168,000 for single and head of household filers, and $242,000 to $252,000 for married filing jointly. This is one of those strategies that feels small in the moment, but over time can become a powerful piece of your wealth building plan. If you got value from this video, hit the like button, subscribe to Finurix Growth, and drop a comment below with your biggest takeaway. Or tell me whether you want the next video to break down the pro rata rule with real tax examples, because that one can save people from costly mistakes.